I'd like to thank everybody for joining us for the July 12th Town Hall meeting for the Aul Financial Group. We want to thank those that are here with us, thank those that do listen to it later, and those that do forward it on to other people if there's things that you think that's an interest. And I also like to thank people for the questions and the things that they have for us to figure out what we can talk about during this time frame. Now, we had a great week last week. The Indiana Jones movie was well attended, so we had that to go on. I did spend a little time with family on vacation up in Indiana with my granddaughter, so that was probably the highlight of my week last week. So we go across from there, and again, I'll thank everybody for being here. Let's go ahead and I'm going to go ahead and stop the share of my screen and then make sure that they have the availability to share. And I'm going to go ahead and turn it on now and go ahead and let Miss Deanna go ahead and get us started today.
Great, thanks. Yeah, I found some interesting data points with with the volatility that we experienced over the last couple of years. I mean, it's certainly been not your average bear is what we would coin that. And with the market declines that we saw in 2022, we're now seeing a surge in the first half of 2023. And but that's also accompanied by a lot of short-term volatility because we're waiting to see if the Fed is going to do another rate hike or if they're going to pause. We're still waiting on estimated earnings reports. So there's a lot of volatility and uncertainty in the market. But unfortunately, what we also see a lot when markets do start to rebound, when we do start seeing this volatility, we start seeing a lot of investor behavior, what we term as fear of missing out. And when you're trying to react and profit from short-term conditions in the market, that's the hallmark of traders and speculators. That is not long-term investing, and it can getting in and out of the market or trying to time or anticipate returns generally does not work out well. And so why do we do it? Why do we behave that way? And so I found something interesting that talks about investor biases. Hopefully you'll be able to see this. Because this is common. It's a common reaction. So if you're in that camp, we're not admonishing you in any way. This is common, and why it's so critical that you focus on the plan and your liquidity needs and long-term needs and some sound fundamentals as far as following a plan. But why do we emotionally react this way when markets are volatile? And so I found this list. Hopefully you guys can see this. I'll make it a little bit bigger. These are just some of the common behavioral biases that we have as investors. And the first one is the illusion of control. We overestimate our abilities to determine when to exit and enter markets. We also underestimate the true randomness and impact of world and market events. Strong emotional urges to jump in or out or to stay on the sidelines. So that one's the predominant bias. Salience bias, excuse me. I thought this was interesting. We focus on things that are emotionally striking. When we're not doing anything, we get bored. So mundane events, so things that are emotionally striking just give us a different reaction than things that are boring and mundane. With the ongoing fanfare surrounding the Federal Reserve and changes in interest rates, we may be missing other more important factors that haven't yet caught our attention. There are a lot of other things going on in the markets that are affecting price movements. Recency bias, we place more importance on recent events than historical events. In this case, the most recent large equity decline that occurred in 2020 quickly rebounded. So we may have concluded that 2022 would follow a similar pattern. So these are the big three. There's more: illusion of control, salience bias, and recency bias. This is the number two is one I was unfamiliar with. So I thought that was interesting. Yes, there are a lot of things going on. I'm sure Steve's going to give you a shorter market update than what I shared, but I wanted to remind you that focusing on the plan, and your needs is one of the things that you hire us to do with you, to determine what's your immediate liquidity needs, because we cannot be focused on the day-to-day movements, the month-to-month movements, or even a year-to-year movement. We have to take a long-term time horizon and follow the plan over the long term to come out with a more successful end game to the plan. So that's what I wanted to share. Thanks, Steve.
Yeah. Deanna, I want to thank you very much. We'll go ahead and turn it over to Mel and let Mel give us an idea of what's going on in his world.
Thanks, Steve. The topic I have today is something I want to share on the screen. I am having an issue. There we go. Here we go. So could your taxes be higher in retirement than or as you approach retirement? There's 5 different ways taxes could rise in the very near future. So I'm going to go through each one of those just to give you a little quick rundown. And if you'd like a copy of this brochure, please let us know. We'll be happy to provide you one. But taxes are a pretty important part of being able to be successfully retired. And if you're able to minimize those taxes, then there's more money left for you. There's less pressure on your investment portfolio to grow if it's not being weighed down by substantially higher taxes. So a couple of ways that could affect you. There actually is 3 possibilities when you get to retirement. Either the taxes could be lower, which is the whole premise of the 401k and IRAs, that you put the money away before taxes while you're in a higher tax bracket, and supposedly you would be in a lower tax bracket when you retire. That came around because taxes were in the 75% range on the top bracket back when they were doing these types, started the IRA and the 401k. Taxes brackets are a lot lower today, so it may not be true that you would be in a lower tax bracket. 2, you could be in the same exact tax bracket. Well, then it becomes an issue. Well, should I do tax planning now if I'm going to be in the exact same tax bracket in the future? There's no leverage for myself. But then we have the potential third one where you could actually be in a higher tax bracket due to different positions. I'll go through 5 different ways you might end up being in a higher tax bracket in the future than you are when you were putting the money away or as you are closing in on retirement. And one of those ways is you could change tax brackets. We'll talk about that. The tax brackets could change around you. Deductions could be eliminated. The way assets are taxed can be changed, and also new taxes can be elected. So let's just look at a few quick examples. One of the things that could happen that a lot of people don't take into consideration when they're looking forward as a married couple is what happens to taxes when you become single. And one of the reasons for a tax bracket change could literally be that the tax bracket would change because when a spouse passes away, the surviving spouse moves into filing from married joint to filing single, and you reach the tax brackets with much lower income streams. So if you were used to a $7,000 a month income and you're in the 22 bracket as a married couple, you might be in the much higher tax bracket as a single person at that same dollar level. So there's that particular change. Excuse me. Tax brackets could change around you. There's a lot of different talk about that. For example, in 2017, Congress passed a law that temporarily cut taxes, and we're still holding for that, but it is due to end and will expire in 2025. So starting in 2026, we should be back into the same tax brackets we were 7 years ago, 6 or 7 years ago. And quite honestly, it's not 22% at 80,000, it's 25%, which is a pretty decent increase. And it can go a lot higher than that. You could very easily get into the 28 or 32% bracket at even lower dollar values. So brackets could change. And there's nothing to say that they will follow through on this. This is written into law that unless Congress does something, this will automatically happen. because the whole law that was passed back in 2017 was sunsetted to end at the end of 2025. Now, will they let this happen, or will they change it, or will they make it even more so, or change the brackets in the future? Hard to say. But with our current debt load and the need for revenue from the country, I can anticipate, and I'm sure you would too, that we're probably going to be having higher taxes and higher tax brackets in the very near future. Deductions are eliminated. They've already started that. There's a lot of different deductions we used to have that are no longer available. One of the more interesting ones is that if they eliminate a deduction, for example, of any kind, then suddenly you're paying taxes on money that you used not to pay taxes on. And there's different variations on that thing, and a lot have been eliminated since 2017. They may, and when they change the rates, they may not bring back the deductions. So essentially, that's a double. You go back to the higher rate brackets, and you don't have the deductions anymore that you used to have. So you could actually be an even higher taxes than we anticipate. The way taxes and the way assets are taxed could change. Back before 1984, Social Security wasn't taxed at all. Then in 83, they passed a law that said, okay, if you have a certain amount of income, then half of your Social Security could be taxed. Then in 93, they changed it again and said that up to 85% of your Social Security could be taxed. Might they come along and say, you know what? All of your Social Security is taxed if you're over a certain income level. That's been discussed and could very well be something that occurred in the very near future. So that's just one example of how the way assets get taxed could change. Another one would be the new taxes are enacted. The crazy one on this one is, I mean, obviously that's what they could do. The old joke is they'll tax breathing because they already tax death. So they might as well tax the other side of it too. The issue here, one that was discussed in the, recently, and by the House Democrats when they were doing the Build Back laws, or plan, I should say, was that if you make over a certain amount, not if you make over a certain, if your IRA or 401k is over a certain dollar level, right now you can have as much money as you want in IRAs and 401ks, and you at 73 or younger, depending on when you were born, you have to take your required minimum distributions. Well, this particular rule that they were discussing said that it would require savers above this cap, whatever the cap is they decide to put on it. Let's say that if you had $1 million in your IRA, then you've got enough as far as they're concerned. And anything over that level, you have to take a required minimum distribution of half of it and pay taxes on it. And every year that would occur. So if you had 1.1 million, you got to take 50,000 out and pay, even if you're not 73. This is for anybody of any age. If you have more than a certain amount, the idea was to make you take half of that excess and pay taxes on it. That's a pretty substantial change. This is something I've heard Steve say on the radio, and I agree that it used to be that taxes were set to incentivize you to save and put money away. And lately it seems to be turned around where you're actually being penalized if you're doing a good job of it. And if you're frugal and put the money away and you do a great job of earning money and saving it and all these different plans, well, gee whiz, you need to be punished for that. If not punished, at least penalized in some way because you did really well with it. So this is only 5 different ways. There are actually a multitude of other possibilities where taxes might go up. Now, so if these things all exist, what do we do about it? Well, that's tax planning. One of the things that we do in our practice is we spend a great deal of time looking at either doing Roth conversions or having assets in the right categories, like taxable buckets, tax deferred, tax free, using life insurance as a tax-free angle, which is a very, very powerful tool. And if you haven't looked into that, you really, really should. In using life insurance as a financial tool to provide tax-free income during your lifetime and also as a legacy for your children. And it has other side benefits, like it might also double as long-term care protection for you also. So there's a lot of things you can do, and we can't protect you from all taxes, of course, but we can help minimize the effect of that. And put yourself in a position where changes in the tax laws might not have as dramatic effect on your particular retirement. So that's my stump for the day.
All righty, thank you very much, Mel. I love having Mel talk about taxes. I think that's the greatest because I'm usually the one that gets to get up on that soapbox and go from there, because I do believe, and I'll say it over and over again, reducing or eliminating taxes in retirement is probably the best thing that you can do for a successful retirement. And then we have to look at taxes today, and coming from the accounting world, where everything was what about are your taxes this year to what would be the taxes over your lifetime, gave a completely different picture on what we start to look at in the tax area. One thing, I'm going to go ahead and start out with some of the events. I want to thank everybody that attended the event back on June 27th. We had a New Orleans style cooking class at the Schnucks deal, and it was fantastic. So when we have one of those again, please watch the newsletter each week. If it's something that you might have an interest in, please go ahead and call Megan during the week and say, Megan, next time we have a cooking class, let me know when we're planning on doing it, and please put my name on the waiting list. So that's one of the things that we have going there. We had the Indiana Jones movie, over the weekend, and we had a big crowd that followed that. So thank you for everybody that came. Thank you to everybody that broadcast. We really appreciate that. On August the 3rd, not that far away, we are going to have the new client appreciation and the client referral dinner. That'll be at Stony River Steakhouse. We do that about 3 to 4 times a year. One, welcome the new clients and thank those people that gave us people like themselves, because you guys are the people that we love doing business with. So any introduction and giving us that, and we just always say thank you for being a part of the family. And then one of the other events that I enjoyed a lot more than I thought I was the Fabulous Fox. We're going to take a tour on that on August the 12th. Because there is no Broadway show at the time, we are going to get to see a lot more of the Fox Theater than we got to see last time. We'll get to see the tunnels that actually go from the back of the theater up to the stage, that the artists that come and perform at the Fox all kind of do their little graffiti, is about the easiest way for me to put it on there. So again, thank you for all of that. Watch the newsletter. Don't hesitate to call the office during the week, ask for Megan, and find out what's going on. So I will go ahead, with the first half of the year is over. It's hard to believe that this, we've passed that point already in 2023. And then we have some stalwarts in the market. Right now, the Dow Jones is up about a little over 3%. The NASDAQ is up over 32% year to date. And the S&P 500 is up about 16%. So we have to start looking at those numbers, but we have to put them into where they were, because that investment advisor math catches people a lot of times. Because if I have a 10% decline, I have to get 12% to get it back. If I have a 20% decline, I got to get 25% to get it back. And then if I have a 50% decline, I have to get a 100% return just to get even. So we'll go back a little bit to those numbers. The NASDAQ is still about 14% below its high. And the S&P 500 is still about 7% below its high. So last year, when the smart beta markets did not have the full losses that happened, they don't have to gain as much, because I will admit, and we'll sit here, they are not returning what the NASDAQ and the S&P 500 have done. So we look at it and sit here and say, okay, we didn't lose as much, but there are some other alternatives. We do have clients out there that are more aggressive by nature. They're willing to go ahead and take more risk almost all the time. We have clients out there that asset protection is the main thing. Steve, I don't really care how much you make. I just don't want to lose anything. I want to lose as little as possible. Well, if you're one of those people that are more aggressive, please give me a call. We are looking at some other portfolios that I would love to sit down and talk to you about. We're thinking about, we have got the room upstairs. I am in the new office upstairs. So we've got that almost ready to go. And when we look at it and sit here and say, we've got some ideas about possible portfolio changes, we are probably going to do open houses here at the office and just bring people in and say, here's what we're thinking, instead of bringing it in at your next review. So those are the things we're constantly looking at, what is going on in the market. The other thing that I want to tell people to be careful, we start chasing returns. We move from point A to point B, and we're chasing returns. A lot of the things that right now is off of the artificial intelligence. Okay, what happens when companies report normal earnings? Are they going to get penalized for them? What if they miss their earnings numbers? What's going to happen to those companies? So those are the things that we're looking at, because there's still quite a few headwinds when we start to look at the market. Interest rates. I believe the Fed will increase it 2 to 3 more times before the end of the year. I don't think it's going to be a carrot where it went up real fast and it's going to drop real fast. I think it's going to be up there for a while. I don't think it's just going to go straight up and then come straight back down. And in 6 months from now, we're going to be sitting there back at 1 to 1.5%, and our home loans are back down in a different area. I don't think that is going to happen. So I don't believe that interest rates are coming down. I believe that inflation is coming more under control, but I think the market reacts to that in a different way. I think that we are a consumer-driven market. So it's when the consumer slows down on the spending is when we'll feel more of what's going on. The negative part about finding out about a recession is you don't find out about a recession in the middle of it. You find out about it after it's over. So my guess is we probably currently are in a recession. So those things are hitting. It's not something you can say, we're starting the recession tomorrow. When they give us that information, they'll say it started on such and such a date and it ended on such and such a date. The negative about that, it's always in the past. It's always in the past. So we'll go from there with it. So there are headwinds out there, which avoid the, chasing returns. We do have some ideas for those that are willing to take a little more risk, with a portion of their portfolio, that we've got some pretty good ideas that we're looking at. I've been talking with the investment team up at Brookstone, and we've been talking about it with, Deanna, Mel, David, and myself have gotten together to talk about what's going on here in our local office. So those are some of the things that we've covered. Again, I will say what I like to say. We've grown exponentially because of referral of family and friends. And we just want to thank everybody that's out there listening for being a part of our family, because that's what I believe it is. And that's, like I say, I like doing business with the clients that we currently have. And that's what I want to continue to do. So thank you very much for everybody that is in here live with us for showing up. And I want to thank everybody that listens to it. If you have any questions, please call the office, ask the question. One of the members of our team will get back to you to answer your question. Again, thank you very much for being a part of the family.